As a business owner or an individual, you have a powerful tool at your disposal to help optimize your tax position: tax planning. With effective tax planning strategies, you can legally and effectively minimize your liabilities, maximize your savings, and keep more of your hard-earned money in your pocket. In today's video, I'll be diving deep into the benefits of tax planning and exploring how you can use it to make smart money decisions and reduce your tax paid. An example I'll show how a business owner could save $50,000 plus in tax. So let's get started on why tax planning can be a game changer for your business or your personal finances. So what is the process of tax planning? Well, tax planning is looking at your expected tax position based on your expected income and then potentially putting strategies in place that are going to help optimize this. So the first key step in that is estimating your income for the year. Now, this does bring up a bit of a challenge of when do you do tax planning? Obviously, the closer you get to the end of the financial year, the more accurate of the estimates can be. But that gives you less time to put strategies in place. And I will be talking more about timing later on in the video. So let's say we've done 9 months of the year. We're now in April. We've got our July to March data and that is locked in. That gives us a pretty good solid 3/4 of the year that we can use that data to then make some estimates about the full 12 months. So we might look at our profit levels for our business, for instance, and after 9 months, we've earned $180,000 of profit. We're earning $20,000 profit on average a month. Now, if you're in some kind of seasonal business, that is something you'll need to keep in mind. But this business we're looking at isn't seasonal, and we're going to expect that $20,000 a month is going to stay pretty consistent for the rest of the financial year. So if we look at now over 12 months, we'd expect profits to be around the $240,000. Now, this gives us that starting point to go, what is my estimated tax liability to this? Now, let's assume all this income is going to be siphoned back to one person, and we're going to be looking at an estimated tax bill of $83,500. So with that in mind, you can then start to go, is this something I'm comfortable paying? Like, do I want to pay $83,500? Or is there a better way for me to structure my affairs over the next 3 months so that I potentially reduce that liability down? Now, one thing to keep in mind when you're doing estimates, they are just estimates. Don't get caught up in, this subscription might rise by $5 next month. Don't worry about that stuff. Hit the big key things. The locked in data is perfectly accurate. The projections are going to be just that. They are projections. But, for instance, if you know you're going to be buying a new car, well, you want to make sure that's factored in because that's going to be material in the overall matter. So we can now take that expected position and we're going to look to optimize it. And this is by looking at what strategies can we put in place to lower our taxable income or to maybe spread out our taxable income so that we're reducing our overall tax liability. The first question I always ask people is, what do you need over the next 12 months that maybe you could bring forward? So if you're a business owner, what are things that you're planning on spending money on that maybe you could bring that expense forward to this year when we've got a higher tax bill and therefore reduce our taxable income, reduce our tax paid? So let's take this example again where we've got that $240,000 income and maybe that business owner is needing a new work ute that's going to be solely used for work purposes. They've been putting it off, but it's got to the point where they really need to buy one. This could be the perfect opportunity for them to buy that ute, create a tax deduction based on the current instant write-off rules, reduce their taxable income down, and therefore reduce their tax paid, all while spending money on something they were going to buy anyway. And that is the key to a lot of strategies is, were you going to do this anyway? Because if you weren't, you need to ask yourself, why am I doing this? If it's just to save tax, is that actually the right decision? Because spending $1 to save 30 cents on tax doesn't make sense if you didn't need to spend that dollar in the first place. So in this situation, the business owner goes out and buys a $50,000 ute. Now this is going to be claimed at the moment under the instant write-off, so we're getting to claim that full amount. And suddenly our taxable income has dropped now to $190,000. Now the estimated tax savings of this was $23,500, so we've dropped our tax bill now down to $60,000. So you can see that's a massive savings based on that. And all we've done is gone and bought something we were going to have to buy anyway. So all about timing and understanding when is the optimal time to make these big purchases happen. Now let's say this business owner, they've been working for themselves and they haven't put any money into super, but they've been keeping some cash there ready to go and do that, but they just want to know, is it optimal in this year? So they're going to look at what is the tax impact of making a super contribution. Now say they didn't actually put anything in last year, so they've got some carried forward benefits that they can utilize, and they've actually got $50,000 that they're wanting to put into super. So they make that decision, they do that, they fill out the correct paperwork so they can claim as a tax deduction, and that happens in this financial year. And now all of a sudden that taxable income has dropped by another $50,000, saving us approximately $20,000. So we've now pretty much halved our tax bill from $83,500 down to $40,000 just by making two decisions that the business owner wanted to do anyway, but they didn't know when the right timing was. And a lot of what happens when it comes to tax is all about timing things in the right manner to make sure you're optimizing your tax position. And this doesn't matter whether you're a business or an individual. You need to understand when is the optimal time to make this big purchase, to make this big expense, to receive this income. Now, after a discussion with their accountant, this business owner has worked out that, well, they're actually running through a trust, and they've made comment that their partner has been helping with the business but isn't being paid any wage. They're not earning any other income. And the opportunity has come up that the profits could actually be split 50-50. Now, by using trust minutes or a trustee distribution resolution that they signed before 30th of June, they've now made the decision that the profits of the business are going to be split 50-50. So our $140,000 is now going to be split into two $70,000 lots, which is going to massively reduce our tax paid again. So both of those individuals will have an estimated $15,000 of tax each, and that's going to give our total tax bill of $30,000. So we've saved over $50,000 from when we started at $83,500 in tax. Now we're only at $30,000 of tax, just by implementing some basic strategies that were likely going to happen anyway, timing them right, making sure our profits are split in a tax effective way, and massively reducing the tax liability for this business. Now, as I've mentioned plenty of times throughout this video, timing is key. This starts right at the start of the process, like I said, about estimating your income. The further you can wait, the better it is, because the more accurate decisions you can make. But the longer you wait, the less time you have to implement these decisions. So if you know not much is going to change, maybe doing it for 9 months is great. If you're in a really seasonal business, maybe you want to wait 10 and a half months before you make your estimates. You want to give yourself time though, especially if some of these decisions are things that are going to take time to happen. For instance, an asset purchase might take time for that asset to be delivered to you. So you want to make sure you've got time so that it is delivered to you before 30th of June. For instance, if you're making a super contribution, you need to make time for the funds to clear to the fund. So go and speak to your fund, look on their website. They'll have timings around how long you need to give them. You can't make a contribution on 30th of June and expect it to hit the fund and all the forms be filled out and you actually get to claim as a tax deduction. That's the worst case scenario. Something that should be timed in this financial year falls into next financial year because you left it too long. So leave yourself enough time to get the key decisions made and processed. You also need to really understand that everyone's situation is unique and there are thousands of strategies that could be implemented, but they might not all apply to your situation. So you really want to understand the strategies that are put in place for yourself. If you're working with your accountant and they say, do this, you really need to understand, why am I doing that and when do I need to do it by and how much of it needs to happen. If you don't understand that, ask the question again. Tax planning is a vital part of running any business, and I think every single business owner should be doing it. It's actually my favorite service I carry out for clients. So if you are interested in tax planning services, get in touch with me. If you're wanting to know more tax strategies that people use to help save them tax, this upcoming video is all about some of the strategies that the rich and powerful use to reduce their tax bills. I thank you for watching. I'll talk to you on that one.